Hey everybody, welcome back to Dividend Stockpile, where we talk about all things dividend and income investing related. So today we're going to discuss why financial expert Dave Ramsey is wrong about his views on dividend stocks. We're going to watch some clips from an episode of his radio show where he answers a caller's questions about dividends. I'll be providing my feedback and opinion on why he's wrong and is doing his listener a disservice. As for my background, I've been investing for over 25 years now, and I focus on dividend stocks, dividend ETFs, income ETFs, and selling options for income. Over those years, I built up my wealth from negative in college to currently substantial amount through hard work, living frugally, and investing in a consistent and conservative manner. Dave Ramsey is a household name, no doubt, known for his no-nonsense advice, and while he's helped millions of people get out of debt, some of his investing ideas may not be the best fit for everyone, especially those who want to invest in dividends. So let's get into it. So first, let's cover what Dave Ramsey actually recommends when it comes to investing. Ramsey is a big proponent of mutual funds, particularly growth-focused mutual funds with long-term track records. That in itself sounds fine. He advocates keeping it simple, investing 15% of your money into 4 different mutual funds: a growth mutual fund, a growth and income one, aggressive growth, and international growth. His approach is focused on growth and avoiding debt, while he doesn't emphasize dividend stocks or ETFs, even for retirement income. But there is one big thing missing here for those of us who are looking for predictable, sustainable income in retirement, and that's dividend investing.
Question comes from James in Wyoming. He says, I'm 28 years old and I'm on baby step 3. I'm looking ahead to baby step 4, where my fiance and I will invest 15% of our income into retirement. What are your thoughts on dividend investing? I was thinking after the house is paid off, the only thing better than no payments is having passive income from our investments covering our living expenses. I want to achieve this before the age of 60, when we can start withdrawing from our retirement. Is this a good way to allocate our 15%? And if so, how does receiving a dividend work with a Roth IRA? Is it still taxed? Great questions from a 28-year-old. I'm impressed.
Oh, very good.
So Clark has a great question. Why not use the 15% that Dave recommends of his savings to invest in dividend stocks for passive income later in life, instead of the traditional mutual funds Dave usually recommends? This is a very popular approach, with millions of investors throughout the world investing in dividend-related companies and ETFs. It lets us buy something that can provide income in the future without us selling off our shares. That's the basis of why someone would want to invest in dividend growth companies. I like the mindset of the caller, so let's check out Dave's response.
Very good. Well, a dividend-paying investment would be typically what's called a blue chip company, a large company, okay, like a General Motors. Okay, they're not usually very exciting in their price changes, up or down, but they make a lot of money. And so when they make money, and when you own a share of stock, you're one of the owners of the company. You own a tiny little piece of the company when you own one share of General Motors stock. If they make a profit and they decide to distribute that profit to the owners, that's called a dividend. And so a dividend-paying investment would typically be large company stocks that are paying out their profits and are fairly predictable on that, and people buy them for that and that only. If that's in a Roth IRA, the dividends stay inside the Roth IRA until you're 59 and a half. It's tax-free like anything else is. But and what you would do is flip the dividends and they reinvest back into more stock is what happens inside of that.
Okay, some thoughts. Well, first off, not all dividend payers are large blue chip companies. They're not boring dinosaurs, as he likes to call them. There are plenty of small cap and mid cap companies that pay and grow their dividend over time. Dave mentions that the company's price doesn't change that much. Well, dividend stocks typically are less volatile than growth stocks, but some of the best dividend stocks have beaten the overall market. So just because it's less volatile, it doesn't mean its returns are any less. Also, as a dividend investor, the primary focus is the dividend and dividend growth. We all also want capital appreciation, but our main focus is on the dividend. So Dave's saying that we only focus on the dividend is just plain wrong. Dave's approach to investing is so rigid and makes anyone else who doesn't follow that exact strategy feel stupid or wrong. He'll even recommend a specific group of people to be your advisors, if that tells you anything.
You cannot pull anything out of a Roth IRA before 59 and a half without getting penalized and taxed. And so we're not going to use that for something to get too early. And I really wouldn't do it.
While this claim is not directly dividend related, he's just wrong when it comes to Roth IRAs. The money you contribute to a Roth IRA is available to withdraw tax and penalty free at any point. The reason is that you've already been taxed on the money before you put it in. Additionally, there are many different ways to get money out of your account before 59 and a half without penalty. And that includes the contributions as well as any earnings or dividends. So some that are most common are things like unreimbursed medical expenses, health insurance premiums while you're unemployed, if you have a permanent disability, or for higher education expenses, both for yourself and your family.
If you want to invest, I would just do 15% of your income into the four types of mutual funds we talk about: growth, growth and income, aggressive growth, and international. If that gets too big and you're getting close to 50 years old and you don't have any money to support you between 55 and 60 or 55 and 59 and a half, then you might just start with something like some index funds. And that's called bridge investing at that point.
Which is a taxable brokerage account where you just invest and it's all going to be taxed when you take it out. But that could be a way.
It's a taxable mutual fund.
Yeah.
Okay, so there's a lot wrong with this advice. A bridge account, as he calls it, is just a fancy term for a brokerage account, and that's not used for retirement. So this is your taxable brokerage account. But it can be used between when you actually retire, or today if you wanted, and the age of 59 and a half when you're allowed to pull your money out tax-free and penalty-free in your IRA or your Roth. The biggest issue I have with Dave's advice is that if you're starting to put money into the account at age 50, like he mentioned, and plan on using that money at, say, 55 or maybe 53 and a half or whatever age you plan to retire, that's not long enough time for growth investing to work. What if there's a downturn or the stocks that you invest in or the mutual funds have no growth during that 5 years? Are you going to be able to use that money when you need to? If you were to invest in dividend paying companies in that bridge account, even if the market goes down, you could use the dividend payments to cover your living expenses and not have to sell your shares. Unlike growth stocks, which require you to sell your shares to gain, dividend stocks pay you to simply hold them. Think about that. With dividends, you're actually getting a share of the company's profits on a regular basis. And with the right dividend stocks, you can expect these payments to grow over time. So instead of having to rely on selling off assets, the 4% rule or whatever method you're going to be using, you can just keep your shares and have a reliable income stream that you can depend on year after year. So if Dave doesn't like dividend stocks, why should you care about it? Well, I'm going to break that down. Dividend stocks offer advantages that align perfectly with building wealth and generating passive income, especially when you're near retirement or looking to diversify your income. And not all dividends are equal. Dividend growth stocks, like those in the S&P 500 Dividend Aristocrats, are companies that increase their dividends year after year. When you invest in these growing dividends, your income potential compounds, meaning your returns can snowball over time. This can be incredibly powerful in building wealth without ever having to sell your shares.
So with your Roth IRA, just leave it in there. It'll be reinvested. It'll still help your money grow. But I wouldn't worry about this as a passive income strategy.
Yeah, you've been reading too many websites.
Passive income is great when you're in retirement and you get the passive income from that investment.
From that Roth IRA, and it's tax-free income. You don't need passive income. And typically these are the calmest of the four types. Okay, the growth and income. It's a growth and income type stock that would be a dividend paying.
And income part.
Yeah, and that's those blue chip big dinosaur companies, and it's the least exciting, the least rate of return. It's the lowest rate of return of the four types we talk about, and that I own.
All right, it shouldn't be needed to be said, but you can invest for passive income before retirement. Groundbreaking. What if you don't want to work until you're 59 and a half? What if you want to take some time off? Or have you or your spouse stop working? Or find a job that's less stressful or less hours? If all your money is in a retirement account, you have no liquidity and no options. Investing for passive income through dividends in a traditional brokerage account that allows you to access it before 59 and a half gives you flexibility and options in life. And isn't that the whole reason why we're saving money and putting money away so we have the flexibility later? Regarding that dividend stocks are less volatile or least volatile, there's four different focus areas. The way I look at it is you don't exactly want to be super volatile when you need the money or you're near retirement. Do you really want to invest in companies like SMCI or Tesla that could swing by double digits on a daily basis? I don't. You don't need that. You need stability and consistency that dividend payers and ETFs can provide. As I always say, sometimes boring is very good.
So I'm 61. I did none of what you're talking about. All I did was buy real estate that I pay cash for and invest in those four types of mutual funds in my 401k. That's really all you need to do if you up to tens of millions. I mean,
you don't need to get fancy.
It's won't make you a billionaire, but you won't be broke, and you'll be a millionaire and a multimillionaire.
You'll end up somewhere in between.
Absolutely.
All he did? He buys real estate with cash now, but that's because he did real estate through loans and went bankrupt in 1988 because he took on too much leverage. And not everyone has cash sitting around to buy a rental property, and not to mention all the work and upkeep owning physical real estate is. Maybe, just maybe, someone who went bankrupt shouldn't be providing financial advice to millions of people. And in addition to his real estate, he wrote books, he has this radio show, YouTube, and a whole training course. The list goes on of ways he's made his money. He did a lot more than just invest in his 4 mutual funds to get wealthy. To be fair, he got wealthy off of his listeners and his readers, those who follow his every word. Overall, his blanket approach to investing recommendations is a disservice to millions of listeners. It is not taking anyone's specific goals, needs, or risk tolerance into consideration. So, what's the risk of ignoring dividend stocks and ETFs? Well, imagine you're retired and the market is down. If you're following Ramsey's advice, you're relying on growth stocks, which means you need to sell shares during a downturn to fund your retirement. But with dividend stocks, as we mentioned earlier, you're less likely to have to sell because you're receiving regular income from your dividends, income that keeps coming in regardless of the market's up and down. And dividends offer a buffer in retirement, providing income even when growth stocks aren't performing well. It's all about having that flexibility and stability, which is often overlooked in Ramsey's method. He thinks growth and growth and growth and growth is the way to go. International stocks, they might do well, but they're more volatile. Growth stocks, we all saw back in the tech boom all the way up to the great financial crisis, growth didn't grow. So it's not the only way to provide income or wealth in retirement. Another argument I have for dividends is the historical data. Dividend stocks, particularly dividend growers, have historically outperformed non-dividend payers in terms of total return. And they usually do it in less volatility. So if you're looking for stability and growth, dividend stocks and ETFs are likely a solid choice. In the long run, dividends not only provide you income, but also tend to outperform many growth-only strategies when reinvested, thanks to the compounding effect of reinvesting those dividends. So let's look at a case example. Let's have some numbers behind all this. Imagine you would have invested $10,000 in a dividend growth stock like Coca-Cola 20 years ago. Of course, we all know Coca-Cola, and it's a company with a solid dividend and dividend history, growing its payout year after year after year. Today, that $10,000 would have grown significantly in value, now worth over $58,000, while also paying you back in dividends every quarter and growing them, creating a steady stream of cash flow. With consistent reinvestment, your dividend payouts could be substantially higher, thanks to the compounding effect of reinvesting your dividends. You're not just building a bigger balance, you're actually building an income-producing asset. A lot of people think dividend investing is just for retirees or people looking for conservative investments. Well, those are two groups that do invest in dividends, but dividend investing can benefit investors at any age. They give you a source of passive income that can grow over time and let you reinvest those payouts for exponential growth. Imagine you're in your 30s or 40s and start building a portfolio of dividend stocks now. By the time you reach retirement or whenever you want to stop working, you can have a reliable income stream, helping you retire sooner or more financial security without having to worry about selling off your shares in a downturn or selling off your assets and not having anything to pass on to future generations. So to sum up, you can probably tell, Dave Ramsey's advice is not my recommendation. He's very good on debt and budgeting, and it may be valuable if you're struggling to keep your head above water financially. But when it comes to his investment advice, it really misses the mark, especially for those who want to focus on generating income. Dividend stocks offer a way to provide wealth, achieve reliable income, and reduce your risk. Dividends can grow over time, both the dividends and the capital appreciation. They provide passive income and can help cushion your portfolio during market downturns because, one, you're receiving the dividend every month, and two, you don't have to sell your shares. Dividend investing isn't just about conservative returns, it's about consistent, reliable growth that allows you to have more control over your retirement. But if you're a fan of dividend stocks or dividend ETFs, make sure you hit the like button and subscribe for more dividend investing insights. Let me know in the comments, do you think Dave Ramsey is wrong about dividends? Or is there value to his mutual fund only strategy that I might be missing? Thanks for watching, and remember, keep stockpiling those dividends. Thanks all.